Good morning. I'm with a new guest today on Goldfinger Capital. His name is Graham Summers, and he goes by Macro King on Substack, and he's also with Phoenix Capital Research. Graham, how are you today?
It's a pleasure to be here. Thank you, Robert.
Yeah, my pleasure. I think this will be an interesting conversation, a different type of guest, a little bit more macro in the orientation. And I want to talk about AI. I want to talk about the broader market with you and maybe the implications for metals and precious metals as well. But why don't you first tell us about yourself?
Sure. So I've been running Phoenix Capital Research since 2009. Before that, I was working at an investment house in Baltimore, Maryland. And essentially, I'm the chief market strategist and the founder for the company. So all of the firm's investment strategy comes through me. What put me on the map originally was that I was one of the few people in 2008 who accurately predicted and told clients what to do in terms of the great financial crisis. Nowadays, a lot of people like to say that they were ahead of the curve on that one. But, you know, the reality is there's only about a handful of us who were openly defying Wall Street and Ben Bernanke at the time. In the spring of 2008, all the Wall Street CEOs were saying they had rock solid balance sheets and everything's fine. I was early in April saying there's going to be a crash, there's going to be a crisis, you need to move to cash now. And then we actually had a bunch of shorts open before Lehman failed. So that sort of catapulted me onto the map, and then had a lot of success during the EU debt crisis. And then since that time sort of pivoted. I actually coined the term the everything bubble in 2014. And then I wrote the best-selling book by the same name in 2017. So I've done a lot of things I'm very proud of, and most recently the focus has been on AI, and obviously specifically for me, how AI kind of ties in with commodities and natural resources. A lot of people are focusing primarily on the tech aspect of AI. I think the more interesting aspect is going to be that we've got this sort of underinvestment in mining and in natural resources that's been in place because of all the ESG policies coming out of the government. And that's happening at a time when suddenly we have this tech revolution that's just demanding, you know, tremendous amounts of hard assets and natural resources to fulfill its sort of promise.
So you are a published author who wrote The Everything Bubble.
Yep, I wrote that, and then I wrote the sequel, The Into the Abyss. That went out in 2024. And essentially, you know, back in 2014 at the time, it sort of struck me we'd been in this era of what you'd consider serial bubbles. And as I dug deeper into all of this, it became very clear that essentially the kind of blueprint for what central bank policymakers were employing was they'd realized that as early as the late 90s, that our financial systems just essentially saturated with debt, especially once you get into unregulated over-the-counter derivatives. And as a result of that, it kind of became this policy to just let bubbles appear in various asset classes. And when those bubbles inevitably burst, you know, paper over it and create another larger bubble. And so we had the tech bubble in the late 90s. Then we had, which was specifically in, you know, technology stocks. Then we had the real estate housing bubble in the early 2000s. That resulted in the great financial crisis. And that obviously was a step up sort of asset class food chain. You know, most people can buy a stock with just, at this point, a few dollars, but typically real estate or a house is the largest financial transaction you'll make in your lifetime. And then when that bubble burst, you know, they essentially tried to corner the bond market. And as you're no doubt aware, you know, the treasuries, the US debt is this essentially the bedrock of our current financial system. And the yields on those bonds are the risk-free rate of return against which stocks, real estate, oil, anything you can name are valued. And so by creating a bubble in treasuries, they were essentially creating a bubble in everything, which is why I called it the everything bubble starting in 2014. And they kind of went into hyperdrive after the pandemic, because during, you know, it's interesting, with each crisis, the policies that are introduced become more and more extreme. And we've sort of gotten a sense of what's to come from Japan. They're about 10 years ahead of us in terms of this sort of prognosis. The Federal Reserve first introduced zero interest rate policy and QE in 2008. QE is an abbreviation for quantitative easing, or printing money and using it to buy debt assets. The Bank of Japan introduced ZIRP in 1999 and QE in 2001. And essentially, they've since sort of done a slow motion nationalization of their financial system. And that's essentially what the Fed's sort of done in the post-pandemic world. During the pandemic, everyone was so worried about COVID. Some of the stuff sort of flew off the radar, but the Fed was buying assets that were completely not in its jurisdiction to be buying. They were buying, corporate bonds, bond ETFs, CDs, asset-backed securities, automotive loans, anything you could name. In fact, one of my friends joked the only thing they weren't buying was old NFL contracts at the time. And that's what unleashed inflation, which became a systemic issue. And then after that, we had the AI revolution. And so now we're in this weird situation where I don't think inflation's ever fully left the financial system. And it's happening at a time where now all of these hard assets and natural resources are going up in value because there's this increased demand from AI.
Interesting. Yeah, that is very interesting that you say that AI is helping to drive the bull market in commodities.
Yes.
So I want to talk about AI, but first let's talk about a Substack that you published this morning about the Mag 7 triggering a crash.
Yeah.
So I think there's three parts to this that I'd like to hone in on. So first of all, the dollar index.
Yeah.
You show a weekly chart. This is actually something I've been pointing out in 2026 as well. And that the dollar has been sort of forming like this bear flag consolidation for the last 7-8 months. And it's technically, if you look at it on multiple time frames, it's testing major long-term support. And obviously, if the dollar breaks that support, it's going to have big implications for a lot of things. So I would like you to expand upon that and sort of what you're seeing here in the dollar and in yields.
Yeah, happy to do that. So essentially, what happened was in the post-pandemic era, it became very clear that the only thing policymakers know how to do is essentially print money and then use that to buy assets. And that's highly inflationary. And that's what created the first significant, between that and the supply chain being disrupted, that created the first, really systemic issue of inflation since the 70s. And as a result of that, you kind of have as a policymaker, you essentially have a choice. Do you want to defend bonds or do you want to defend the currency? And historically, what policymakers do is they'll defend bonds, because if you devalue your currency, I mean, that's all the Fed's done since they were created in 1913 is, the dollar's lost like 95% of its purchasing power. So, but if you devalue your currency, things sort of stay afloat. But if you don't defend bonds, if you let the bond market become unruly, you very quickly get into a crisis situation like what happened with Greece or what happened with Spain and the pigs in the 2011, 2012. So essentially, that's sort of the game plan that's happened since COVID. And the Trump administration were very opposed to this initially. If you remember in the 2024 campaign trail, the president was saying at the time, we're going to balance the budget, we're going to cut spending with Doge, and then we're going to raise revenue with tariffs, and we're going to balance the budget, and we're going to solve the debt issue. And they tried all that, and it lasted about 60 days before the bond market started blowing up in their faces, and they essentially panicked and reversed everything. Doge, it cancels contracts and it reduces spending, but it's a drop in the bucket when you consider the big, beautiful bill increases spending by $5 trillion. And similarly, the tariffs, they've brought in, I think it's almost $300 billion in total revenue since they were implemented on Liberation Day. But again, we're actually running a larger fiscal deficit now than we were, or not larger, only slightly smaller fiscal deficit than we were under the Biden administration. So the Trump administration is just all in on sort of run it hot as a macro framework. And what that does is it devalues the dollar, and the dollar lost, about 12% in the first half of 2026. But the interesting thing is the dollar is now refusing to break down. And that's something I noted in this morning's note. You're very astute to point out the dollar's at these, sort of critical line. If you look at a multi-decade chart of the dollar, it's at like a 15-year trend line. And if it breaks that, it opens the door to obviously much lower levels, which would be highly inflationary. But right now it's holding it. My personal view is I don't think we'd break that just yet. I think it's more likely that we see things start to get kind of hairy in the financial system, and then the Fed starts really aggressively easing, and then we'll take it out. Maybe second half of this year, early 2027.
Interesting. So you think that the dollar might hold, this key support area around 96, 97 in the dollar index. But you also think that yields might fall through the support here, which is kind of interesting because, I would think that if we're about to get a big inflation, that yields would be about to soar.
Yes, that's very astute, very true. I think that we're due for a kind of market hiccup. I switched to getting a lot more bearish in the last couple of weeks. My view from late November was that the overall market didn't really have a lot of demand driving it. Typically, when you get a major bottom in stocks, you have what's called a 90% U-vol, an up volume day, a day where 90% of trading volume is related to advancing stocks, or at least you get multiple 80% U-vols. We didn't have that at all with this low that came in around Thanksgiving. We only had one 80% U-vol, which suggests that there's very little deep pocket institutional demand driving stocks. And then you throw in some of these other things that are showing up, like we had record stock inflows in January of 156 billion. You look at sort of sentiment, extremely frothy in some ways. And then you look at what's leading the market right now. It's old economy sectors of the market, things like industrials, consumer staples, and the like, energy. Those are usually things that show up at the end of a cycle. So I've actually gotten a lot more bearish in the last couple of weeks. And my view now is I wouldn't be surprised if we see a significant correction of, say, 10% in stocks, or even a potential bear market, a 20% drop into the summer of this year. And I think that would coincide with yields falling dramatically, the dollar rallying, risk assets essentially selling off. And then I think the Fed will get really aggressive defending things, especially now that the Fed's essentially co-opted by President Trump, who, for political reasons, doesn't want to lose the midterms. And so I think we'll see some really aggressive monetary easing going into the second half of 2026.
Okay, so that makes sense. So you have the thesis is market drop 10% at least over the next few months. Big flight to safety into the US dollar.
Yes.
Yields fall through the floor, also flight to safety into treasuries.
Right.
And then they respond around mid-year, right in time for the midterms. It's full, liquidity spigots, fire hose.
Yeah, exactly.
The dollar has a U-turn lower, and then yields go up into year end. Okay, so that is a market call I can back. That makes sense to me. That's pretty logical. It's interesting you say about sentiment. So we were pretty bullish at the beginning of the year, but recently in the last few weeks, I'm starting to notice a lot of people getting kind of bearish here and thinking that we're about to have a drop. And obviously what's happening in the Middle East, I think, is helping to fuel that, because obviously if a major war is about to break out, that's going to be risk off, right? So I saw the put call ratio yesterday, and I was like, holy cow. When the put call spikes like that, it's really hard for me to be bearish, because just like, like you, I've been around 20 plus years, right? And so like my experience is when the put call spikes like we saw this week, that's like the only time you're going to have a market crash in that highly hedged environment is a Lehman Brothers kind of moment, right? So it's literally once in a decade at most.
Yeah, I agree with that. I think it's quite possible we get a significant bounce here. The tariffs were just struck down by the Supreme Court this morning. Mag 7's getting a bid from that. Things are definitely skewed in terms of hedging with put call ratio, as you pointed out, and that's very astute. The bearish situation for me is more just the sort of risk cycle. And I think a big reason why people are getting bearish is just because of market structure. As you're no doubt are aware, we're in the S&P 500 is a very tech heavy index. Tech accounts for about a third of market weight. And in fact, tech is bigger. It's more heavily weighted than the second and third most heavily weighted sectors combined. It's almost more heavily weighted than second, third, and fourth heavily weighted sectors combined. And big tech's really been struggling since essentially September. And then you throw in what's going on with software, where we're in an absolute just bloodbath. And I think the bearishness is coming out of that. The bigger issue, for as far as I'm concerned, is if tech can struggle, and provided the other sectors are strong, then the market will kind of hold up, which is essentially what's happened since the late November lows. You've seen tech going nowhere or falling, but you've had other sort of leadership appear. But if any of that leadership rolls over, we'll go down very, very fast. So I do think, based, as you pointed out, the put call ratio suggests we might get a bounce here. But my view is I think we're seeing a significant trend change, and that we're going to start entering a downtrend going into the second quarter of this year.
Okay. Very good. Okay, let's talk about AI, right? This is everybody. AI. Look, there's no doubt it's affecting all of our lives by now.
Right.
There's no way to avoid it, right?
Yes.
And in fact, I think more of us just need to embrace it and use the tools to make our lives better, right? But how is AI going to affect the economy? Because I read some really scary prognostications out there that we're going to have like 20 million people laid off in the US in the next 2 years.
We're going to have a depression in this country.
Yeah, we're going to have a depression. So what's what's actually going to happen?
Isn't that the multi-trillion-dollar question? It's very hard to say. I can throw just from a historical precedent, when the internet came out, everyone was saying at the time, oh, we're going to see entire industries vanish, like retail. No one's going to shop retail anymore because it'll all be e-commerce or travel agents or things like that. Anything that's in person is going to disappear. It's all going to be online. Those industries are still around. They just integrated the internet in a way. And in fact, retail leadership is now companies like Amazon or Walmart that's gone aggressively into e-commerce, but they're obviously still bricks and mortar stores. I think I wouldn't be surprised to see AI play out in a similar fashion, where it doesn't induce some kind of depression where everyone loses their job, but rather it just changes the economy in profound ways and creates new jobs where people are sort of interacting with it much like they do the internet. Goldman Sachs had some research that said something like 60% of current jobs didn't even exist 50 years ago. The economy's changed so dramatically that 60% of the current jobs people have 50 years ago, those jobs didn't even exist. And I wouldn't be surprised to see something like that with AI. Behind the scenes, there's some interesting things playing out in the AI space. There's a gentleman, I don't remember his name at the moment, but he was the head of Meta's AI lab for many years. And he recently was replaced by a younger gentleman that Zuckerberg acquired via a $15 billion check he wrote last year. He bought the younger guy's business. And the older gentleman actually just quit. And the main reason why they had this falling out was his view is that AI is never going to be able to think like a human being. He just doesn't agree on that one at all. Mark Zuckerberg's all in. They're all in on this AGI, sort of generalized intelligence, this idea that AI is going to be able to think exactly like a person. But if you read between the lines, some of the industry insiders are completely splitting off from that. And you're also seeing some weird moves being taken by people. It's one thing to come out and say, oh, I think AI is going to cost us, 20 million jobs, but there's no risk to saying that. You're just making a big claim. But if you look at what companies are doing with their money, NVIDIA just pulled back from a $100 billion deal with OpenAI. They just reduced it down to 30 billion. And SoftBank, which is another big investor in OpenAI, they haven't announced that they're going to commit to the next round of funding for OpenAI. You're also seeing the AI trade change so rapidly. From when ChatGPT came out in November of 2023, since that time, AI-related stocks have accounted for, I think it's 75% of S&P 500 gains, 80% of profits, and 95% of capex. And this was essentially a AI-driven big tech hyperscaler market, a market where Meta, Alphabet, Microsoft, Amazon, they're all spending hundreds of billions of dollars building out these networks. But then you suddenly get a sudden change where like Anthropic comes out and says, well, our AI can now write code, and all the software stocks, including Microsoft, sell off and go into a bear market. So it's very hard to see. The one thing that's obvious is it's going to be a very winding road. It's not like AI is just going to be introduced and be sort of embraced and be this linear sort of change for the economy. And in fact, what's really peculiar, if I'm brutally honest, is that despite the fact AI is kind of all anyone ever talks about, actual corporate adoption is very low. Bank of America had a piece out saying something like only 15% of large businesses actually have introduced AI to their services and operations. And smaller companies, it's only 7% adoption rate. So in spite of the fact that this is something all anyone talks about, the actual corporations introducing this stuff, it's a very low percentage. It's mostly the big tech guys who are building out the infrastructure. But like everyone else, you'll see Novo Nordisk might announce with NVIDIA that they're going to, use AI to develop new drugs or things like that. But these are just announcements and deals. Actual implementation's very low. So we're still very early in terms of some of this stuff. And I think that might open the door to what I was talking about earlier with some risk off, because everyone seems to have this view that AI is going to unfold really rapidly and it's all going to change very quickly. But if we find out that the actual sort of implementation and success from AI is actually going to take much longer, well, then that would really upset the apple cart in terms of sort of projections for how things are going to go the next year or two.
Yeah. So it's interesting looking at charts like Palantir and Meta.
Mm-hmm.
I mean, obviously, like Palantir has had a really bad 2026 so far.
Yep.
And so this sector, the mega cap tech, stock sensitive to AI, have really rolled over in the last couple of months, as you pointed out. But meanwhile, you also pointed out that the industrials and the energy stocks have picked it up. And have led the market. I don't know necessarily higher, but with the S&P and the Dow near at the highs, right? So it's interesting. It's a sector rotation market environment, and bull markets do this every so often, right? So what we're seeing is nothing unusual, but it is notable that the leaders of 2024 and 2025 are getting shot down a little bit here. Stocks like Palantir were definitely market darlings in the last couple of years, right? So with the artificial intelligence, what are the impacts that you see most likely on the unemployment rate, the economy, and potentially then what Fed monetary policy has to do to adjust to how the labor market is changing here?
Well, that's really hard to predict. My experience with AI has been I can only talk from my own experience. I mean, I have no idea what Mark Zuckerberg's got access to, or, these guys who are saying these things about how we're all going to, Elon Musk says we're all going to be, sipping Mai Tais in our hammocks while the robots do all the work. I mean, I don't know what those guys are seeing that makes them say that. My experience with AI has been that it's a very powerful tool, that as an entrepreneur, you can do things that previously would require an entire department, weeks of work. You can do it relatively quickly, but you have to have really an expert understanding of what you're trying to do for it to work, because it makes mistakes. And, some of the data coming out about some of these AI learning models is a little disturbing. I think I read the hallucination rate is like 30 to 40%. And hallucination for AI is when it tells you something as if it's factual, but it's incorrect. And the way that this kind of gets caught is when you're dealing with experts. If you're dealing with a college kid trying to write a paper on something, that person can go into an AI model and say, write this, and the AI does it, and it sounds accurate. But if you read what people who are like high-level lawyers or surgeons or people who have, really expert understanding of a subject matter, I'd include myself in terms in some areas of the economy on that. When I go into AI, or those people go into AI and they write something, the AI gives you something back. And it might be close to home, but you'll find these just bizarre, completely untrue hallucinations in there. And you're like, wait a minute, what? Like, I remember I was asking it, you know, what did Trump say about critical minerals or crypto? No, it's crypto. What did Trump say about crypto? And it said, Trump said this, and it gave me all these quotes. And then I actually went on to Google and looked for the quotes, and he never said any of that stuff. It just sort of, and I actually told it that's incorrect. And it said, I'm not kidding. Oh, you're right. That's not right. And he actually did this instead. So, you know, that's kind of, I think, indicative of where AI is right now. Like, I really have a great deal of difficulty believing this technology is going to think like a person. It definitely is very handy for some things, but if you don't have a really expert understanding of what you're doing, or you don't challenge it, you'll get some really crazy stuff coming out there. And you're starting to see this because people are trying to cut corners in the economy. I saw a couple of lawyers in New York just got dinged because they basically got caught using AI on their whatever it's called. Basically, the judge knew that the cases they were referencing were not real cases and just called them out on it. They got fined. So it's amazing that it didn't get disbarred. But, you know, I think we're going to see that kind of thing more and more. It's unlikely. And this is kind of brings us back to that point we were making earlier, like what would cause a market sell-off? You know, if AI turns out to be capable of fulfilling the potential they say, but let's say it takes 3 years instead of the next 12 months, because that's what they're all saying is Microsoft's AI chief just came out and said in like 12, 18 months, AI is going to be able to do the work of a lawyer and accountant at like an expert level. Well, what if that actually takes 3 to 5 years to happen? Well, then those, you know, markets are all based on expectations. And if the current expectation that we're going to suddenly see this massive boost in productivity, and we're going to see costs dropping, and we're going to see growth accelerate. Well, if that does take place, but say it's spread out over 5 years instead of the next 2 years, that could really upset the market, because the market's trading, and you're seeing this in the case of like Palantir. You know, if you're trading at 300 times earnings, and it's because everyone assumes you're going to double revenues every 4 months, and actually that's not going to happen at all, then yeah, you're going to nosedive and wipe out 40% of your market cap, like what's happened.
Yeah, some really good points there. So yeah, with AI, one of the interesting things that I've noticed is in the mining industry, especially junior mining, a lot of investors who are not technically savvy in terms of the science of exploration will ask questions to Grok or ChatGPT, and they'll get these really robust answers that sound fantastic. Like they'll say, you know, this company drilled this drill hole here, and these were the results. What does that mean? And Grok is like saying, well, it means you have a great copper mine. You know, it's like, and it gives you in language that sounds like it's an expert. And it can trick people who are non-experts, right? And so we see this constantly on social media, where a lot of investors are regurgitating stuff from the AI.
Yeah, just AI slop.
Yeah, it's slop from the AI, and they're thinking they have an expert insight, but really, it's not, and it's very, misleading, quite frankly, because one drill hole is never enough to know if you have a mine. 5 drill holes is never enough to know if you actually have an ore body that could be a mine. You might get some really good information from those 5 holes, but it's a lot more complicated than that. So you actually have to really continue to ask the AI question after question and sort of hammer it down to get a more exact answer that might actually be something real. But I will say that I've noticed it's improved a lot in the last 6 to 12 months, to the point where like 12 months ago, I would never use the AI for anything, for literally anything. Now I will use it to check data, pull information fast that would take me 5 hours to pull together. It can do it in 3 or 4 minutes, right?
There you go.
So it is a useful tool, but you need an expert there to double and triple check everything, because there's a lot of slop that gets spit out. So look, I think it's great, and it's going to make all of our lives a lot better over the next few years. It's probably not as rapidly transformative as a lot of people are making it out to be, but you know,
I agree with you completely.
Who knows?
On that. Yeah, who knows? I agree with you completely on that, especially.
Yeah.
No, I go ahead, please.
Yeah, so the thing that concerns me a little more from the economy and labor standpoint is self-driving cars and robotics. But I think even with like Tesla, you know, Elon's been overly optimistic for a decade on self-driving. But it seems like we're getting pretty close. I know Waymo is active in a few cities out west. So it's close right now. How rapidly can they get those fleets out there over the next couple of years? I don't know, but clearly we're at the cusp of the self-driving revolution. And there's a lot of Uber drivers in the world. There's a lot of Uber drivers in the US and Canada, right? And I worry about that. I really worry about that. And
you could
robotics,
look at services like customer support. A lot of people work in those industries. 2 million people work in customer support. Those people, that might not be such a great place to be working with AI really can deliver anything like they say, you know?
Yeah, so we're going to get to the point where, you know, humans are still going to be there, but they're going to have to level up their game. Like, for example, a driver, how can you make your product more value add? Like, how can you make the experience better for the passenger? What other things can you add aside from just getting from point A to point B, right? You know,
so you see the economy is going to become more like experiential in nature, that there'll
luxury experiential,
higher premium on the experience as opposed to just the basic service. I could see that. I could definitely see that.
But there's a lot of people that just want to get from point A to point B. I mean, that's the travel industry, is just get me from point A to point B. I mean, like Ryanair, Spirit, the actual experience is far from great. But if you can get me from Miami to New York for $100, sign me up, right?
Yeah, so that's got more into the microeconomics, like the specifics of certain sectors. And I remember when I was doing my MBA at Duke, they you know, Virgin Air was an interesting case study because Branson's view was like, oh, well, people want quality experience when they're flying, and they'd be willing to pay a lot more money for that. What he found is that some people are. But the base assumption for flying for most people is that it's going to suck. You know, nobody thinks, oh man, I can't wait to go to the airline. It's going to be fantastic, you know, unless it's a private jet. And he ended up, you know, having a lot of problems in the airline industry because the baseline assumption is that it stinks. I just want to get from point A to point B. And as long as you can do that cheaply, it's good enough for me. I don't anticipate needing a lot of luxury for that. So I agree with you. I think AI, I don't know if AI is going to be this kind of across the board game changer for everything. I think it's going to be more every single industry will introduce it, but it will have different ramifications for those industries. You know, like in mining, you raised the point earlier, AI makes it sound like these drilling results are incredible. Maybe that's not really the impact AI has. I was reading just earlier today, AI is already being used by some companies like BHP Billiton and the like, because what they do is they've realized that 60% of car accidents that happen at mines are from fatigue or bad judgment. So what they've done is they've put these sensors on their drivers, and the sensors alert the company if the person's starting to drive erratically or if they're starting to act, you know, their body language or body, I don't know what you'd call it. The sensor picks up on the fact they're drowsy and essentially immediately alerts the company, and they've seen a dramatic drop in accidents, which is really good for the mine, really good for public safety. So there are these little, I don't know if it's going to be just I doubt we're all sitting drinking Mai Tais while the robots do everything. I think it's much more going to be, you improve things a little bit here, you improve them a little bit here, you improve them a little, and overall the company improves significantly. but I don't think it's going to be something where they just fire, millions of people and it's one guy sitting with like, an army of robots, and that's what all the corporations are going to look like. I think it's much more going to be tailor-made to specific little ways to improve productivity and improve quality of service.
Yeah, 100%.
Yeah.
So final question, Grant.
Yeah.
And we'll wrap up.
Sure.
What is your take on precious metals
Mhm.
and, metals more broadly? Obviously, copper has a lot to do with the, hyperscale
Mhm.
data centers that are being
Mhm.
built out. Yeah, I'm
Mhm.
just kind of interested in your thoughts on that.
Yeah, that's a great. So let's start with precious metals. One of the big cardinal sins in our industry is you're never supposed to say it's different this time. But when it comes to precious metals, it actually is different this time in a couple key ways. For the first time since the mid 90s, you really see central banks aggressively buying precious metals. They're buying 1,000 tons of gold a year starting in 2022. That's different. So it's not different as it's never happened before, but it's the first time in a generation that's been the case. Similarly, you're starting to see Wall Street and large institutions advocate that their clients allocate money to precious metals. Again, that's different. That hasn't been the case for decades. So between just those two alone, central banks and large financial institutions, you've got very deep pockets that are starting to allocate capital to precious metals that haven't for at least 25, 30 years. Moreover, I think everyone's kind of figured out that nobody really has what it takes to stamp out inflation in the financial system. Cost of living in this country, we're in a very K-shaped economy right now where, the top, say 10% of the country is doing great because they own, stocks and real estate, and they also typically have higher paying jobs. But everyone else, the cost of living is going up a lot more rapidly than their incomes are. And I think everyone's kind of figuring out that inflation never really fully left the financial system, and it's likely it's not going to, because for it to do that, you'd have to really cause some tough medicine to be swallowed that politically people are not willing to stomach. So I think that's also very bullish for precious metals. In terms of recent price action, we had this kind of bear raid take place. I mean, gold and silver had both gone parabolic. Nothing goes straight up in investing. So we were due for a pullback, but we had that 35% drop in silver in a single day, and gold, I think, went down 12%. And just as a trader, when you see something sell off that hard in one day, it's never going to bounce back right away. You usually have a couple of weeks, if not months, of kind of consolidation. The only time you get V bottoms and things is usually in stocks, and that's because of an intervention. But as you're no doubt aware, the powers that be are not interested in intervening in gold and silver and forcing them higher, like they are with stocks. So that's the sort of case for precious metals. In terms of the industrial metals, and I would also say silver would be considered an industrial metal as well as a precious metal. The big kind of rubber hits the road for AI is not going to be the software side. It's going to be more the hardware side, the robots, the automations, the kind of hard assets like physical AI, I guess you could call it. And that's going to entail tremendous amounts of natural resources, things like copper, steel, lithium, cobalt, and the like. And that's really, Robert Friedland, I'm sure you're familiar with him, from Ivanhoe Mines, came out and said, we need to mine as much copper in the next 18 years as we have in the last 10,000 if we want to even maintain 3% GDP growth. So, and that's sort of, as I'm sure you've talked about before, the result of we've underinvested in producing this stuff. We had the ESG craze going on where everyone said we're going to go to green, clean energy. And the reality is physics doesn't support that, and we're going to have to turn back to hard resources. And especially if AI is as power hungry as it sounds like, we're going to need to mine a lot of stuff and produce a lot of stuff, and it's going to cause quite a boom in the mining industry.
Yeah, very good. It's interesting that you mentioned Robert Friedland, because
Yeah,
it's interesting to see how that message has gotten out in the last couple months. I wrote about that on January 7th on my Substack, and I linked to a video he did, and I
saw
talked
that.
about it. Yeah, and that article went crazy viral, and I was like, wow, he's been saying this since 2022, like. But something about this moment here in 2026 and what's happening in in the world today got people's attention, right? It got
it's really interesting that people will say the same thing and then suddenly the culture's like ready to hear it.
Yeah, they're ready to hear it. Yeah, they have the ears for it. In 2022, nobody was interested in what Robert Friedland had to say about copper or any of these other metals. Now he's waxing on about scandium and how we need more scandium for hypersonic missiles or fighter jets or what have you. And then obviously tungsten and antimony, like all these metals that nobody had really cared about for 50 years. I mean, we haven't focused on mining tungsten since the Vietnam War, right? It's just we bought it from somewhere else, right? We got it from somewhere else. So now the cupboard is bare. I mean, the US does actually have some copper mines. We actually do, but we only have two copper smelters, and they're kind of archaic. I mean, like these are, smelters that were built in the 60s and 70s that are still running with some upgrades, but they're not modernized, right? And so there's a lot of heavy lifting that has to be done. And if we're gonna actually build out these hyperscale data centers that are very large, they're basically campuses, and they're super copper intensive, well, we're going to need to build at least a couple more modernized smelters, and that's just for copper, right? There's a lot of other metals out there. So this is a big lift. I mean, this is not a small undertaking. Like, this is like a World War II sort of mobilization that the US has to do around metals and minerals and processing of these elements. Graham, thank you.
My pleasure. That's actually the exact framework I've been telling clients. We're in a wartime economy right now. I agree with you 100%.
Yeah, it is a wartime economy. Look, I'll give you the final word. Tell everybody how they can read more and hear more from you. And thank you.
Oh, it's a pleasure to be here. Thanks, Robert. If you Google Phoenix Capital Research, that's my investment research firm where we publish market analysis and trade recommendations. Macro King, Graham Summers MBA is where I am at Substack. That's a different branch of things. You can find me on Amazon, my books, The Everything Bubble and Into the Abyss. And I'm also on X, formerly Twitter. Just Google Graham Summers MBA. You'll find me everywhere. Just make sure you have the MBA, because otherwise you're going to find, I think there's a soccer player who's in high school and there's a lawyer in Indiana. So I'm not either of those. So,
All right, Graham, thank you so much.
It's a pleasure to be here. Thank you, Robert.